On a Tuesday morning in March, Sarah Chen checked her investment account while drinking coffee at her kitchen table. She'd bought 200 shares of a utilities company 6 months earlier and mostly forgotten about them. But there, sitting in her cash balance, was an extra $78 she hadn't deposited. No sale had occurred. The stock price hadn't changed. The money had simply appeared. Sarah stared at her phone, confused and curious. Where did this money come from? This is the moment most people first encounter the strange, almost magical concept of dividend stocks. And what Sarah discovered that morning would completely change how she thought about investing. Here's what happened. Sarah owned a piece of a company. That company made a profit. And instead of keeping all that profit, the company's board of directors decided to share some of it with the owners, the shareholders. That's the essence of a dividend. When you own stock, you own a slice of a real business. And some businesses, especially mature, stable ones, regularly distribute a portion of their earnings directly to shareholders. It's not magic. It's not interest from a bank. It's your share of the company's actual profit, landing in your account 4 times a year, or sometimes monthly. Think of it as a paycheck for being an owner. Let's break down the mechanics step by step. First, a company earns profit over a quarter or a year. Second, the board of directors meets and decides how much of that profit to retain for growth and how much to distribute. Third, they declare a dividend, announcing the amount per share and the important dates. Fourth, if you own the stock on what's called the ex-dividend date, you're entitled to the payment. Fifth, on the payment date, usually a few weeks later, the money hits your brokerage account. Sixth, you can spend it, reinvest it, or let it accumulate. This cycle repeats, often quarterly, creating a predictable stream of income completely separate from whether the stock price goes up or down. The ex-dividend date confuses almost everyone at first. Marcus, a graphic designer from Portland, thought he could buy a stock the day before it paid a dividend and immediately collect the money. He bought 300 shares on what he thought was perfect timing. The dividend was announced at $1 per share. He expected $300. But nothing came. Here's why. The ex-dividend date is typically 2 business days before the record date. If you buy on or after the ex-dividend date, the dividend goes to the previous owner, not you. Marcus had bought too late. The stock price even drops by roughly the dividend amount on the ex-dividend date, reflecting that the value has left the company. Understanding this timing is crucial. Not all companies pay dividends, and there's a reason. Young, fast-growing companies like tech startups typically reinvest every dollar back into expansion, research, and growth. They need that cash. But mature companies, ones that have already captured their markets like utilities, consumer staples, and established banks often generate more cash than they can effectively reinvest. Paying dividends serves several purposes. It attracts income-focused investors, signals financial health and confidence, rewards loyal shareholders, and provides discipline to management. A company that commits to paying dividends quarterly can't easily waste money on bad acquisitions or pet projects. That cash is promised to you, the owner. When Sarah started researching, she kept seeing a percentage called dividend yield. At first, she thought it was like a savings account interest rate. It's similar, but with crucial differences. Dividend yield is calculated by taking the annual dividend per share and dividing it by the current stock price. If a stock costs $100 and pays $4 annually in dividends, the yield is 4%. But here's the key. Unlike a bond or savings account, the yield changes constantly as the stock price moves. A falling stock price increases the yield mathematically, but might signal trouble. A rising price lowers the yield. The yield is a snapshot, not a guarantee. Understanding this distinction prevents dangerous mistakes. 3 months into her dividend journey, Sarah found a stock yielding 12%. Most dividend stocks yield between 2 and 5%, so 12 seemed incredible. She almost invested her entire savings. Fortunately, she researched first. The company was struggling. Its stock price had collapsed from $80 to $20 over 2 years. The dividend, which had stayed constant at $2.40, now yielded 12% only because the price had crashed. 2 weeks later, the company cut its dividend by 75%. The yield trap had been set. High yields often signal distress, not opportunity. A sustainable dividend comes from healthy earnings, not mathematical artifacts of a falling stock price. Professional dividend investors focus on something different than the highest yield. They hunt for dividend growth. A company that pays a 2% yield but increases its dividend by 8% every year becomes far more valuable over time than a company paying 6% that never grows. Imagine buying a stock at $50 that pays $1 annually, a 2% yield. If that dividend grows 8% yearly, in 10 years you're receiving $2.16 per share on your original $50 investment. That's a 4.3% yield on your original cost. Meanwhile, the stock price has likely risen too, because growing dividends reflect growing profits. This strategy, called dividend growth investing, has created substantial wealth for patient investors. In Sarah's research, she discovered a special club, the Dividend Aristocrats. These are S&P 500 companies that have increased their dividends every single year for at least 25 consecutive years. Through recessions, market crashes, pandemics, and economic chaos, these companies kept raising their payouts. There are currently about 65 aristocrats. Some have streaks exceeding 50 years. This track record demonstrates exceptional business quality, financial discipline, and shareholder commitment. These aren't the flashiest stocks. They're companies making unglamorous products like adhesives, beverages, cleaning supplies, and industrial equipment. But their consistency creates a foundation for income investors. Sarah decided to build her portfolio around aristocrats and similar dividend growers, accepting lower initial yields for reliability and growth. On her fourth dividend payment, Sarah faced a choice. She could take the $92 as cash or reinvest it. Her brokerage offered a DRIP, a dividend reinvestment plan. With a DRIP enabled, dividends automatically purchase additional shares or fractional shares of the same stock, often with no commission. This creates a compounding effect. Those new shares generate their own dividends next quarter, which buy more shares, which generate more dividends. Over decades, this compounding becomes extraordinarily powerful. A $10,000 investment in a dividend-growing stock with dividends reinvested can become vastly larger than the same investment with dividends taken as cash. Sarah enabled DRIP on all her holdings. She wouldn't see the cash, but she'd own more of the business every quarter. The following January, Sarah received tax forms and discovered dividends have tax implications. In the United States, dividends are categorized as either qualified or non-qualified. Qualified dividends, from stocks you've held for at least 60 days during the 121-day period surrounding the ex-dividend date, are taxed at lower capital gains rates, 0, 15, or 20% depending on income. Non-qualified dividends are taxed as ordinary income, potentially much higher. Furthermore, dividends in taxable accounts are taxed the year you receive them, even if you reinvest them. In retirement accounts like IRAs or 401ks, dividends grow tax-deferred or tax-free. This makes dividend stocks especially powerful in retirement accounts, where the compounding isn't reduced by annual taxation. Sarah shifted her dividend strategy between account types based on this knowledge. Not every dividend story has a happy ending. James, Sarah's colleague, invested heavily in an energy company paying a 7% yield. The company's earnings were declining, and its payout ratio, the percentage of earnings paid as dividends, exceeded 90%. Financial analysts warned the dividend was unsustainable. James ignored the warnings, attracted by the high yield. 6 months later, the company slashed its dividend by 60%. The stock price fell 30% in a single day. James lost both income and capital. The lesson: monitor the payout ratio. If a company pays out more than 75 to 80% of earnings as dividends, there's little margin for error. Economic downturns, industry disruptions, or company-specific problems can force cuts. Dividend safety matters more than dividend size. A year into her journey, Sarah had built a diversified dividend portfolio. She owned 15 different stocks across sectors: utilities, consumer staples, healthcare, industrials, and financials. No single position exceeded 10% of her portfolio. She focused on companies with 20-plus year track records of dividend growth, payout ratios under 70%, and yields between 2 and 4%. Each quarter, dividends arrived like clockwork. Some months brought payments from 3 or 4 companies. Sarah tracked her annual dividend income, which had grown from $240 in year 1 to over $600 by year 2, thanks to reinvestment and dividend increases. The income was small but growing, and more importantly, it required zero additional work after the initial research and purchase. What fascinated Sarah most was the snowball effect she could model. She calculated that if she added $500 monthly to her dividend portfolio and reinvested all dividends, and if her holdings averaged 3% dividend growth annually, in 25 years she'd be receiving over $15,000 annually in dividend income from a portfolio worth roughly $300,000. The dividends alone would cover several months of her expenses. In 35 years, the annual income could exceed $40,000. This wasn't speculation on stock prices doubling or tripling. This was simply owning profitable businesses that shared their profits with her and increased those profits modestly over time. The math was straightforward but powerful. Time and compounding did the heavy lifting. Through conversations with other dividend investors and her own near mistakes, Sarah compiled a list of common errors. First, chasing the highest yields without investigating why they're high. Second, ignoring the payout ratio and dividend coverage. Third, failing to diversify across sectors and companies. Fourth, not understanding the ex-dividend date timing. Fifth, holding dividend stocks in taxable accounts when retirement accounts are available. Sixth, expecting dividends to replace income immediately rather than building over years. Seventh, selling dividend growers after short-term price declines, interrupting the compounding process. Each mistake costs money, time, or opportunity. Learning from others' errors accelerates your own progress. Sarah kept this list visible as a reminder whenever she evaluated a new investment. 2 years after that first unexpected $78, Sarah understood something profound. Dividend stocks aren't primarily about getting rich quickly or beating the market. They're about gradually transferring from being someone who must work for money to someone whose assets work for them. Every quarter, businesses she partially owned operated, sold products, earned profits, and shared those profits with her. She didn't manage those businesses. She didn't work at them. She simply owned small pieces of them. The dividend checks were proof that capitalism, at its core, allows regular people to own productive assets. That ownership generates cash flow. And that cash flow, reinvested and compounded over decades, builds financial independence. Sarah still worked her job, but she now understood a path forward where, eventually, she wouldn't have to. If you're inspired to explore dividend investing, start simple. First, open a brokerage account if you don't have one. Many offer fractional shares and commission-free trading. Second, research 5 to 10 dividend aristocrats or dividend growth companies in different sectors. Third, check their dividend history, payout ratios, and business fundamentals. Fourth, start with small investments in 2 or 3 companies to learn the mechanics. Fifth, enable dividend reinvestment if building long-term wealth is your goal. Sixth, add consistently, even small amounts, taking advantage of dollar-cost averaging. Seventh, track your annual dividend income and watch it grow. The most important step is the first one. Sarah's journey started with curiosity about $78 unexpected dollars. Yours can start today, right now, with the decision to become an owner, not just an observer, of the businesses that shape our world.